I think it's fair to say that we are in for some true turbulent times in 2024. Guys, we're going to talk about what's going on in the economy, and there's a lot to unpack. Obviously, we're all feeling it in our savings accounts, inflation. Mainstream media has been just talking about how great everything is. But now that we're cruising into 2024 and we saw a little dip in mortgage interest rates, we could tell by the turbulence that they're on their way back up. And many people, it's a mixed bag, whether they think we'll be back in 4% rates or whether we'll see over 8% rates this year, despite the Federal Reserve doing any kind of Fed rate drops. I'm really honored right now to be sharing the screen with a friend of mine, and he has a YouTube channel. Maybe some of you already follow him. It's Nobody Special Finance, and it's Jack Gamble here, and Jack's going to fill us in on some of his predictions. But not only is this really a special occasion to have Jack visiting here at our office, our location here at Sachs Realty in Maryland. Jack came down. We're going to do some in the field live videos in some of the neighborhoods around Maryland. Take a look at some of the newer home markets and see what's going on, with the sales. Are they moving inventory or not? So more on that to come. But this, ladies and gentlemen, is our very first podcast in our brand new studio. So Jack, welcome, man. Thank you so much for joining me here on this special occasion.
Thank you so much for having me, Todd. It is a pleasure to be your guinea pig for your new studio. Congratulations. This place is fantastic.
Thank you very much. So tell everybody a little bit about you and your channel.
Well, Nobody Special is the name of my channel, and that's kind of a little bit of an inside joke in that I don't really have any formal financial pedigree, right? My background is mechanical engineering. I worked in nuclear power for 15 years. No formal financial, right? No degrees in finance, no career experience in finance. But I live in numbers. I live in charts. My job when I worked in nuclear power, it was my job to watch performance data of equipment, vibrations on pumps, pressures, discharges, flows, and look for things that weren't behaving right and identify those things and draw attention to them before they broke. Obviously, you want to fix things at a nuclear plant before it breaks. And I found that's translated pretty well into finance. You're basically looking at a trend and looking for something that maybe doesn't really match what some of the other data is saying and trying to say, hey, something is broken here, and then position yourself ahead of time.
And you do that every day on a live show?
Yes, every morning, 9 a.m. Eastern time, I go live. I do financial news, status update for the market, and then I also do investigative pieces if there is a scandal or some high-profile bankruptcy, or if I think there's an emerging weakness in the economy somewhere. I like to peel 3 layers deep, so to speak. Why is this happening? And then, well, why is that happening? What caused that? And what caused that? And go several layers deep on a subject, and that's kind of the niche that the channel has settled into.
Yeah. Well, let's talk about a scandal for a minute then. I mean, that's kind of exciting. So what's your latest scandal? What have you uncovered?
The latest scandal that I uncovered, it was about a week and a half ago. There was an article in The Guardian by a journalist named Sarah Martin, who wrote an article that was largely based on the work of a fellow YouTuber, a guy named Danny DeHeck, who goes by the Crypto Ponzi Scheme Avenger. And he was dealing with the Hyperverse, which was the largest crypto fraud of 2022. It was a $1.3 billion scam that the developers made off with. And this article in The Guardian was about the CEO of this company that didn't exist. There was this man, Stephen Reese Lewis was the name of the CEO. He had this very impressive resume. He worked at Goldman Sachs. He worked at Adobe. He went to Cambridge and Leeds. This guy was really sharp, except the problem is that wasn't his name. He wasn't real. I mean, he was a real guy, but it was a fake name, a fake resume for a fake company. And the Guardian article was all about, we can't prove this guy even existed. And so I was fascinated by that story. I decided to dive deep into that. I set my mind to it. I said, we're going to find this guy. And I used a combination of facial recognition software with a little bit of obsessive compulsive disorder maybe. And I was able to track this guy down to, the guy's real name was Steve Harrison. And he was just this party animal from Bangkok, Thailand. I was able to find him using the facial recognition search, which is a little scary. A lot of people commented like, this day and age, everything leaves a footprint and an electronic trail. There is no hiding anything. Tracked him down to some background images at bars in Thailand and Bangkok, started running facial recognition of the people he was out drinking with, led me to a Facebook page of another guy who lived in Bangkok, Thailand, started looking around at his pictures, and there he was. There's our fake CEO. I found the guy's name.
Was he benefiting from the company? I mean, was it? You say it was a fraud scheme. I mean, was there a financial benefit there?
Well, in a shocking turn of events, he insisted he had no idea there was any fraud going on there and that he's totally innocent and he's really sorry. So I'm sure that's a lot of comfort to the people who lost the $1.3 billion.
Wow.
He claims he was a paid actor, that he was only made about $7,000 plus a free suit. There were perks, apparently. And he...
Hopefully a good suit.
I guess it was a good suit.
A nice suit.
But he claimed he had no way of knowing this was a scam when these people approached him and asked him to use a fake name and pretend to be their CEO.
Wow, that's crazy.
That's a little hard to believe, but...
Well, good job.
Thank you.
For finding out all about him. Tell us about the economy, man. What is going on? Because I know there's a big concern. The 10-year, at the time I was shooting this video, the 10-year Treasury has gone up again. Everyone was kind of expecting that mortgage interest rates would be dropping, and they did. But now we'll probably, quite possibly, be over 7% here again in the next week or two. So what's going on, man? What's the number one thing right now that's really rocking the U.S. economy?
So the 10 years kind of a curious case, right? All through last year, right up until about Halloween, just straight up and to the right. And then Bill Ackman comes out, announces he covered his short on U.S. Treasuries, and interest rates started to fall. So there's a lot of conflicting messaging in the mainstream financial press. They're saying, well, people are front running the Fed anticipated rate cuts. Well, if everything is so good, why would the Fed cut? Nobody's asking that question. Unemployment at historic lows, as they love to remind us, asset valuations all-time highs across the board. Why would they cut? You cut rates to stir more lending, to stimulate. Well, what are they stimulating? It's already rather stimulated if you believe the what's going on the surface. What really I think is happening, because the Fed doesn't control the 10-year, at least not directly. I mean, they can mess with their balance sheet to affect it, but really the Fed only controls the short end of the yield curve. The long end does what it wants. And when I see yields dropping on the 10-year, that is big money positioning for safety. And, that's happening while gold is hovering pretty close to all-time highs, around $2,000 an ounce. So the 10-year Treasury is not telling us the message that the media is giving us. They're telling us the soft landing, the economy is great, even no landing, that, we've made recessions obsolete. That's not what the 10-year is telling us.
Why do you think the media is not publishing that?
The media makes its money, at least the financial media. They are paid by institutions that have a financial interest in keeping that bubble inflated as long as possible. So, ultimately they're beholden to the people that pay their checks. So I think there's a little bit of that going on. Anytime you're dealing with the press, you're going to have political influence. So that could be playing a role. And then, there's just the ownership class, if you will, the super wealthy in this country have benefited tremendously from this sugar high economy that is destroying the middle class, driving a lot of people down into the lower class, even below the poverty line in this country, while asset valuations are at all-time highs. So they're obviously seeing all the benefit from this erosion of savings and standard of living of the middle class. So there's certainly financial incentives to keep that narrative going.
So tell us, what's the breaking point? What's broken with the economy? I mean, if we have the cheerleading on one side saying everything is great, and we have, the Fed, the pressure on the Fed to drop rates, whether the pressure is coming from the banking industry, Wall Street, the White House. Maybe the pressures are coming from all kinds of angles to drop rates. We're looking at a time where banks are, they're said to be not in great shape. So, what's the breaking point? At what point, what's really, how do we fix this?
Ultimately, asset prices have to come back down to earth, right? We've been talking a lot on sidebars about how home values, the price to income ratios, that obviously not sustainable. And you look around in America's cities at people living in tents and people being priced out of the housing market. Home prices need to come back down, or incomes need to radically rise. Well, the Federal Reserve is not going to let the incomes radically rise. They've told us that. They're watching wages. They don't want to see wage spiral inflation. That Keynesian boogeyman that hides in every closet, according to the powers that be in the financial press, can't let people make more money. Well, then the home prices have to come down because people can't afford to rent them even. And the cost to rent right now is about 40% lower than the cost to own in some markets. So if people can't even afford to rent them, then obviously those costs to ownership are not sustainable. And a lot of those investment properties out there are not going to be cash flowing and will hit the market soon enough. So I think home prices need to come down. As far as what is broken in the economy, probably be easier to talk about what's not broken. I mean, really, unemployment is the one thing that I still see as a silver lining. It's still pretty low. There is some underlying weakness in the jobs markets, like we're losing full-time jobs and adding part-time jobs. We're seeing rises in multiple job holders. That's not a sign of prosperity. That's a sign of people getting desperate. And that's also lower standards of living.
People are holding 2 and 3 jobs.
Yeah. And, keep in mind that that's a statistic. That's a number. When you're looking at these charts and these reports, and I see, I believe it was 222,000 multiple job holders added last month in the jobs report, that the market, the press was saying it was so good because of the headline number. That's 222,000 cases of dad is not there to tuck the kids in at night, or not at a little league game, or mom has to leave right as the kids are sitting down and needing help with their homework to go work the second job. That's people's lives being ruined behind those numbers there. And it really is gaslighting to see them go out in the press and say 216,000 jobs added on the headline. Stop reading there. Everything is so good. And you're even seeing these mainstream economists like Paul Krugman, Nobel Prize winning economist Paul Krugman, who's saying the problem is all the bad economic vibes out there. People have it so good and they just don't know it yet. And I remember reading this and thinking, it's such a shame all these people are homeless. If they had an address, we could send them a copy of the New York Times and they could read Paul Krugman's article about how good they have it. So there's a lot of gaslighting going on in the financial press, but unemployment is the one thing that is still not really showed up, even though there are some underlying weaknesses there.
But how about the people that have backed out of the market?
Just
they're no
left the
longer
job
looking
market.
they're no longer looking for jobs.
Yep.
I mean, that's a big number.
We've seen somewhat of a rise in labor force participation rate since the tightening cycle started. But it is still well below pre-COVID levels. So a lot of people left the workforce and have not come back in yet. I think the rate hikes is part of that, inflicting financial hardship on people to force them to come back into the job market and accept a wage that hasn't risen
They have to
enough.
actually pay their mortgage now and their rents.
They have forbearance coming in.
I mean, so now they're forced to go back. What about the 439,000 jobs that were erased about a month ago from the 2023 numbers? So the government erased those jobs, they say quietly, on a yahoofinance.com article that I read. It's everywhere, though. It's a Wall Street Journal, I think. The fact that 439,000 jobs were misreported.
Yeah,
Did you hear that?
That was I believe, the cumulative downward revisions to the headline numbers.
Right.
Yeah, we saw that in 11 out of 12 months. 10 out of the 11 months. We still haven't had a chance to revise December's numbers yet, but that's coming. Virtually every month last year, they went back after the initial headline, after all of the self-congratulating in the press about how strong the economy was, and they would downwardly revise the prior jobs reports. It happened almost every month last year. Take this most recent one, for example, the 216,000 jobs added. That was the headline. The economy was so good. Well, there was 71,000 cumulative reductions to prior months included in that. And everybody was so happy that the 216,000 jobs added exceeded the 170,000 expected. Well, if you subtract the 71,000 downward revisions to prior months, there was actually a miss. Only about 145,000 jobs were added. No mention of that.
Do you think we'll finally start seeing unemployment rise now that they say the recession, well, I mean, some say we've been in a recession. We've redefined recession. And now I think it's fair to say that since about mid-October, or call it fall of 2023, we saw a major paradigm shift in confidence, job market confidence. A lot of layoffs, a lot of people have lost their jobs. And do you think that, I mean, this is not a good time for that to be happening, right? We have an election cycle here, election year. Do you think that we'll start seeing skyrocketing unemployment numbers?
Skyrocketing, and the election is going to be close. Historically speaking, if you go back and you look at the prior Fed tightening cycles, within 3 to 6 months of the first rate cut, you get a vertical line straight up in the unemployment rate. That's when your black swan event happens, a few months after the rate cut starts. So the Fed is always reactionary. They always move too late. So right now, the market is expecting March to be the first rate cut. It's about 60% likelihood, according to futures pricing. Sometime between March and May is going to be
75 basis points is what they're saying.
It would be they're pricing in 7 rate cuts for the year. They'll probably be in 25 basis point increments 7 times. Whether it comes in March or May, that historically that would start your 3 to 6 month clock. So if it comes in May is the first cut, and it takes 6 months to see that spike in unemployment, well, we would get the election in before we really see that turmoil. If it starts in March and it only takes 3 months, we could be looking at a repeat of 2008, where everything is going to hell in a handbasket right as the election hits.
I think that's going to happen anyway. I think it's impossible to not. You can push it, but so far, and I guess maybe they will rely on the media, not covering it. But I mean, obviously, here's the unique part about what is going on with affordability is you can tell people all you want that everything is great, but like you said about the homeless person that's living in the street that says, everything they're doing fine, they're not. So the people that we're seeing now, talk about the housing market, we're starting to see where people bought in the height of the market, which really we saw a peak somewhere around May or June of 2022. And, but those that have purchased in 21 are already listing their houses for sale. And we are still seeing where they are right now in certain markets, like in Maryland, for instance, where we do have still a relatively stable housing market. We're seeing price reductions. Baltimore City, I think, is the most. I think in December, maybe I reported on in one of our shows, but I think it was somewhere around 40% of the active listings in Baltimore had price reductions, at least one. But a lot of that is just people overpricing still. We have seen a weakening in the market, strong sales decline based on people they can't afford it, like you said. But we're starting to see where people from 21 that bought at the absolute top of the market are still able to sell. And maybe, I analyzed one deal where they had to bring like probably $20,000 to the table to get out of the house. So, well, let's talk about the debt because, and maybe we can segue into that a little bit. I want to just cover debt and then a little bit more on the housing market, but let's talk about the crisis in the Red Sea.
So, that one sprang up a couple of weeks ago. I'm surprised it took as long as it did to really affect things because the missiles were being fired at ships for a good month and a half before it really got any mainstream attention. This was not something that just popped off one day. It was a slow boil until one day, all of a sudden, hey, there have been 20 different attacks on ships, either drones, missiles, or hijacking. So the Red Sea is interesting. It came along at just the right time for a lot of the sea carriers because international freight rates were in the toilet. A lot of those companies were going belly up. And these are companies that were making serious bank in 2021 with, remember, the logjam at U.S. ports and the shipping rates were exploding higher. Well, they all borrowed money and they all started building new ships for this, shortage of everything. And then, of course, the market overcorrected right as these ships are now completed and finished, and freight rates just collapsed. So the shipping carriers, the Red Sea was almost a bailout for them because shipping rates have exploded higher, and they were given a lifeline because of that. That's going to be inflationary. Eventually, that's going to translate into upward pressure on consumer prices. I don't know if it's going to be enough to override the disinflationary impulses of the Fed's rate hikes, which we still haven't felt fully that. Also, the disinflationary impulses of just this debt pile. As debt is defaulted on, like we're starting to see in commercial real estate, that's going to see money going up in smoke. And when money goes up in smoke, it puts downward pressure on prices. So the Red Sea crisis it will further stress global trade. It will accelerate the trend of deglobalization, nearshoring, reshoring. It'll add a little inflationary pressure, but ultimately I think the deflationary pressures will probably still prevail this year.
You know, at a time when the Panama Canal is dry and they're not able to get ships through the Panama Canal, so that adds to the freight cost. So it'll be interesting to see what happens to these product prices, these gross domestic products that we import, that we rely on as U.S. consumers. And, that's not going to be at a good timing either. Yep. Because what are you going to do? Tell these stores that they need to take a loss in order to make everything seem great at the cash register? I don't think that's going to happen. How about the debt? Let's just briefly talk about consumer debt.
So debt at every level of our economy is supporting things. We take away debt, take away new debt, our ability to make the problem bigger, and this economy falls flat on its face like an airplane in a stall. It just drops out of the sky. For example, government debt. If we were to balance the budget tomorrow, say everybody, we had this miracle in Congress, they all decide to sing Kumbaya and start getting along, and they actually cut spending, imagine that, and they balanced the budget. That single act alone would send us into the worst recession since 1929. Deficit spending, just new government debt last year, new federal government debt, was 7% of GDP. So if we were to see a balanced budget, we would instantly see a 7% decline in gross domestic product. Put that in perspective, at the peak of the GFC, U.S. GDP shrank by 4.5%. So just the act of balancing the federal budget, not paying off any of the debt, just not making our $34 trillion pile bigger, would collapse the economy worse than the GFC. And of course, it would be even worse because as the economy collapsed 7% from a decline in government spending, tax revenues would start to fall. And so when tax revenues fall, demands on government services get bigger. The deficits would actually explode higher. So the problem of debt is so big, it cannot possibly be solved. We are well past that point. So the question is, what kind of a default? Is it going to be an inflationary default or a deflationary default? Are we going to not raise the debt ceiling and default, that catastrophic scenario, or are we just going to hyperinflate away the dollar to the point where $34 trillion isn't what it used to be? Probably the latter, right? Because of the lack of financial education in this country. People think inflation isn't default when it really is. But it's not just government debt. It's at every facet of the economy. I just did a video on my channel about buy now, pay later loans.
It's crazy.
And I couldn't believe what I found.
Putting groceries on that.
The average credit score of a BNPL borrower is subprime, 580 to 660. That's the average. Half of them are lower
Seems
than that.
predatory.
It's predatory at both ends. I think it's the middle class that's suffering because they're lending money to people that will not pay it back. Right? These are people who are already up to their eyeballs in credit card debt, already not paying their student loans back.
Why else would they do it?
So they're buying things on these BNPL loans when they've already got 580 credit scores. They're not going to pay it back. There's no asset to repossess. They're unsecured loans. They're not going to come repossess a sweater or corn, if you paid for groceries. But then what are they doing with that debt once they take it? That's the thing. They're packaging it up into securities, into asset-backed securities, and they're selling it. And they're selling it to mostly income ETFs. And income ETFs usually end up in people's retirements. And financial advisors put their middle-class clients into those things.
Jeez.
And these ETFs are paying yields like 5.5%. So For all the risk they're taking, they own unsecured BNPL loans to people with 580 credit scores, and they're getting 5.5% interest. Well, take away financial advisor fees, 4.5% interest. That's less than a 1-month T-bill for some of the most toxic debt, and these people don't even know they own it. So ultimately, it's the middle class that's paying for it because the ownership class is collecting their fees. You've got Cross River Bank, one of the sleaziest banks in the country. They're collecting their fee for generating the loan. Companies like Affirm and Klarna get the fee from the vendors to offer the buy now, pay later loans. The firms that securitize the debt and the ETFs, they collect the fees. The financial advisors collect the fees. The middle class takes all the risk, and the people with the 580 credit scores get the free stuff. So ultimately, the super rich and the super poor are making out like bandits, and it's the people in the middle that are going to pay for it.
Yeah, that is definitely trouble on the horizon. Let's talk about the housing market. You know, you had said that, you know, all asset classes, and by the way, I mean, you know, I think that if you, and I'm not a financial advisor, and don't claim to be one, you do not want my financial advice. I've never done well in the stock market. I've actually done the exact opposite. I think it's gambling, and for me, anyway, it's no good. But I do believe in asset-backed investments. Real estate. I mean, I'm in the real estate industry, and I think, you know, when we look at the risk there, is that really isn't good, because when you buy real estate, you owe the bank the money. So you're the one at the most risk, because if you put any money down or you invested anything in the house, you fixed it up, you know, built it out, did whatever, what happens is if you stop paying that bill, they're not nice and say, oh, well, we had to sell it for a loss, but here's your cut anyway. They go, no, we want it all, and now you still owe us money, you know, whether they write it off or not, which they did in '08. But that's the scary part when we're looking at salaries that it takes somebody, and I deal with people all the time. They're like, man, I want to buy, but I can't. I've been waiting. You know, they make not enough money. And, you know, God forbid if they're a single income earner. These people are really struggling, which we want a lot of times. I mean, there are couples that decide that they want that. They want, you know, somebody to stay home and take care of the kids and not pay $1,000 for daycare a week, which they can't afford. So when we look at something like this, you know, a lot of people don't think we will have any type of correction in the housing market pricing. What do you think? With all your research and studies, your data collecting, which you're very good. By the way, guys, Jack's information is in the show notes here. You click over, go see his channel, subscribe to it, check out his live streams. Obviously, pretty smart guy here. Does a lot of his nobody special. Well, he says that, but the reason is because he's done his own homework, his own research, made his own money in finance and things like that by strategizing. And we're going to see a market crash, a housing market crash.
I'm having a hard time envisioning any scenario where we don't, right? I mean, we've been here exactly where we are before, right? In 2005, everybody was saying it's okay. They're not making any more of it when it comes to real estate. You've always, at the end of the day, there's a house backing it. There's an asset behind it. Okay, that doesn't mean the value of that asset can't fall, especially if that value is purely debt fueled. And that's what it is. It's purely debt fueled. That new value in your home is a combination of the dollar has lost value and your ability to borrow in order to pay that price has increased. So it's not an inherent value in the home. It's really more of a function of the debt market. And, well, debt is more expensive now. Our friend Travis uses the term golden handcuffs all the time. There's a lot of people who just won't sell because they got that 2.5% mortgage in 21 when they refied. And that's fine, but sooner or later, divorces happen.
They're going to sell.
People move. The military moves families around. You inherit grandma's house, something like that. Those houses will hit the market, and it's going to be somebody who borrowed at 2.5% trying to sell to somebody who's borrowing at 6.5%. That price has got to come down, and it hasn't happened yet. So I'm in a little bit of a state of disbelief that it hasn't happened yet, because like a lot of other people who are paying attention, I've been calling for a housing crash for the better part of a year and a half now, and it hasn't happened yet. But while the crash hasn't happened, things like payment to income ratios have gone from the mid 30s, which used to be viewed as a limit, to the mid 40s, which
even over
is
50.
a death sentence.
Even over 50 in some cases.
Yeah,
I think with
50.
FHA.
And oh, by the way, that over 50% just for the cost of living or just for the shelter, everything else you have to buy with the remaining 50% has also gotten more
Right,
expensive.
and that's 50% debt to income ratio. So that means that their house payment is 50% in that case of their pay. And that's not counting when the roof goes bad, right? So, I mean, the debt even climbs from there. Well, we'll kind of wrap it up at this point, but I know you say there hasn't been a housing market crash. And in a sense, it really has been. We have seen a massive change since prior to 2022. One of the biggest things is that we're not seeing those over appraised value escalation clauses, which is huge because that ramped up the pricing so fast, so hot and heavy because they were the new comps. So when mom and dad was gifting their son or daughter $50,000 for that cash that they needed to buy something over appraised value, not having that anymore is that's a big crash in itself. But I know what you mean. I mean, we're not seeing, what you're saying is we're not seeing those big losses, the high foreclosures and things like that. Hopefully we won't. I'm not championing, foreclosures. I don't want to see people lose their homes, but Jack, I really appreciate your time, man. I hope everybody, you guys got a lot from this video. If you did, you can smash the thumbs up. That'll let Jack and I know that you enjoyed the video. And if you haven't subscribed to our channel yet, you may want to consider doing so now. Hit that alert bell, every time we upload content just like this. We'll see you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.